Hello, everyone. Welcome to the Genesis Home Podcast, where we talk to experts in real estate, finance, business, community, and beyond, covering topics that are important to us. Let's listen in. And I'm here with
Jason Marcus from Freedom Mortgage.
Hey, Jason.
Hi.
So we've been trying to do this for a while, and I think because it's to sync up. But Jason, you are how you technically in mortgage, but that's really not what entirely what you do. So
what I do is I work as a loan officer in a mortgage bank. So what my purpose is to structure mortgage plans for people, help figure out their budget, what the cost will be to this potential transaction, and set them in motion to find their hopefully home of their dreams. There's a lot of moving parts and a lot of components to it. I have the unique ability to not only advise people on the mortgage end of things, but because I'm going through financials and kind of seeing overall pictures, and depending on where they are in life, it becomes super interesting in my world in regards to other holes I see in people's complete financial picture, where I can sit there and kind of, even though not give specific advice to exactly what to do, I can kind of guide people along in regards to helping them structure long-term plans in other parts of their financial picture. So beside the natural function of my job being helping people structure mortgage plans and figuring out exactly where they would qualify for something, just being blessed and over the course of my career, talking to financial planners and accountants and real estate agents and inspectors and appraisers, you start to learn so much about this stuff that I become the center of attention at any table I'm sitting at a wedding.
That was nice. So what made you decide to get into this industry?
Well, one of the things that most people joke about is nobody as a child says, I want to grow up to be a mortgage loan officer. So most of the people that wind up getting into this industry, a lot of it is either from people they know, which was in my case. I have a mom that worked for bank attorneys, a sister that was a processor at the time and inevitably became an underwriter. I went to the University of Albany, and when I came back to Long Island, I was kind of floundering a little bit. The decision whether to inevitably go to law school, but at that point in time, all you heard was there's more people in law school than there are lawyers, and that you're going to struggle trying to get into that. And at that point in time, I was sort of sick of school anyway. So Mom was really the first where she was like, Jay, you have a really great personality, so I think you'd be good in sales, but you have such structure and work ethic, which this industry kind of lacks a little bit, where she was like, this might be a super good fit for you. I got into it, and like most people on the sales side, like it's not easy. It takes a while and persistence at it, but inevitably one day you wake up, you kind of know what you're doing. If you bought into the philosophy that I bought into, where it's help people first and the money will come, that's kind of the direction I went. So I spent a lot of time just learning, mastering my craft, but most importantly, trying to help people. And that started paying dividends in really, really large ways, where now it's kind of, as I'm teaching other loan officers and junior loan officers under me, that really is the basis of the philosophy on where I really start. Organization skills, time management, but most importantly, help people.
Now, so you mentioned something that was really interesting. You mentioned helping other loan officers that are under you, like junior loan officers and things like that. But you don't do just that. I mean, you also are really big on collaboration. I mean, at least I've seen it, and that's kind of how we met. we were working on something that didn't work out, but you taught me so much. So what is that like, working with like the agents and the attorneys? And you mentioned so many moving parts. What's the process for those moving parts, and how do you maintain those relationships?
Well, what winds up happening in when you're working on the level that I'm at, which is the mortgage banker level, we don't get supplied leads. So early in my career, you had to go out there and create relationships. And in the mortgage world, the smartest people to create relationships and really to get to the next level and to find success in this has to do mostly with real estate agents, financial planners, and attorneys. So when you're sitting there and you're prospecting, like anybody's trying to prospect, you need to show value. So one of the things that I needed to do was really establish myself in mostly with real estate agents more than anybody else, because that's where most of the business comes from, especially at the beginning. The value where I was not just like a commodity. Real estate agents are getting hit with mortgage people all the time. And it's like, everybody's saying the same thing. Let me get leads from you. I'll pre-approve your clients. I'll hand you a letter. I'll send them in the way out to look for things. And, inevitably I'll write this mortgage and get them approved and closed. Well, that's all fine and good. But what I started to do was recognize the fact that if I have a real estate relationship with a particular realtor and they don't see the value in what I bring to the table, I'm just going to inevitably get sold out and they'll start just using somebody else and they look at me as a commodity. So what I started realizing is I need to come up with ways and plans on helping to take these people, the realtors or the financial planners or the attorneys or what have you, to another level. So what I started to do, especially in the real estate side of things, I really started to dissect and learn about the inner workings of their business and the things that I could do to help them take it to another level. And over the course of time, just from learning that part of the business, you start to find and recognize holes in their business. And there's a lot of there's things that cross over. Like when it comes down to the time management of things, regardless if you're a real estate agent or you're a mortgage lender, those parts really coincide with each other. Each of us really knows that for us to be successful, we need to manage our time properly and the organization skills. So I started recognizing this stuff and bringing value on that side. I started understanding social media and just even advertising with, postcards or how to follow up on open houses. Just a lot of different things that I was trying to either delegate to people on my team to help real estate agents open up more time for them to focus on what they are successful at and how they can make more money, and to start to basically teach them how to focus on the things that they're good at and delegate the things that they either don't like or they're not so good at. And this all started to create this whirlwind of success on my side. And people started not just looking at me as, oh, there's another mortgage guy that can buy me lunch or bring a box of donuts. This is a person that can actually has a vested interest in growing my business. And I want to reciprocate that with trying to help them grow their business. Those relationships become so important and solid. And that's how we start taking each other to another level.
Okay, so you mentioned in quite a few parts about holes, how to address certain issues when in the lending process for a potential buyer, or holes in our businesses. My question to that is, how do you identify those markers? Like, for example, when you mentioned about how to get the potential client from the applicant to, a homeowner, which you're the most important part of that process. Let's be honest.
It's a great question. So there's going to be holes in things on the mortgage end of things, and then there's holes in things that I started to recognize on the life side of things. So one of obviously the key parts in the mortgage portion of it, a lot of it falls on the credit side of stuff. And most people aren't really all that up to date, let's just say, or even knowledgeable about the algorithms that are triggered by the credit bureaus. And a lot of times, what's happening is I'm running these credit reports and I'm looking at certain things that have to deal with, um, let's talk about student loans and how they're having an effect on people's credit reports. The impact of credit cards and balances versus limits and installment loans or lates. There's so many different factions to just the credit part of it where I'm dissecting and informing people on things to do to better themselves. So in a lot of cases, what I really love is the client that comes to me months before they're planning on even looking. So that way I can maximize their position with that. And if there are holes on the credit side of stuff, start to help them close those holes, learn the rules, learn how to navigate through fixing their credit and getting them to a better level, which will hopefully lead to a cheaper interest rate, better loan product, what have you. So that's that portion of it. Sometimes it falls into the income side of it, where I explain to people how they qualify based on income and debt versus what a mortgage payment's going to be. And that propels people sometimes to kick in their boss's door and ask for more money. One of the things I've recognized over the course of time are a lot of people are super afraid of confrontation. I'll sit there and I'll look at somebody who's been making the same income for years and kind of like when we're having this discussion and we're doing the breakdown and let's say they don't qualify for what they had hoped that they qualified for, sometimes there's almost like a tough love component where it's like, what's keeping you from asking for more money? You've been stuck in this position doing this for so long. And it's like, I can see that there's a fear there. And sometimes that'll push people to kind of getting out of their comfort zone and doing something that gets them into a better position because the worst that can be said is no. That's really on the mortgage side of stuff. As I sat and myself learned the components on the financial planning side, be it the importance of life insurance, health proxies, wills, and things of that nature, I start to, depending on where my client is in life, start to have those conversations. And what people like about me having those conversations is I have no vested interest in it. I might refer somebody if they should so want to take it to that next level. But a lot of times when I'm talking about these things, they know I'm coming from a solid, honest place because I'm not going to make any money if somebody's buying life insurance. It has no vested interest on my side where I'm it's going to help me in any way, shape, or form. I'm just doing this because I've learned so much over the course of 20 years in each of these categories where I'll have the insight for somebody and I know the importance of eliminating risk in life. So if I'm talking to a couple that's buying their first house and just had a newborn, the first thing I'm going to make sure that they do as soon as they're done with the mortgage side of stuff, or at least I'm going to recommend it, is put them in a position where a will gets put into place and a health proxy gets situated, because that's the first level of safety that needs to happen. And a lot of times I'll point out just from what I'm seeing in, is it intelligent to borrow against your retirement to like basically pad the down payment, or are they max contributing to that? Or are they sitting with an exorbitant amount of money in accounts that are earning absolutely no interest, where it's like, hey, listen, here's a thought or an idea for helping you, inevitably achieve these pillars to get to retirement faster. I have the unique ability, because people are opening up to me on their financial world, to sit there and see these things. So what I try to do is give them insight on things that I've learned over the course of time, so that way they can sit there and at least start having those types of conversations to better themselves. Once again, creating clients for life because I'm providing value.
You mentioned something really interesting. I think it all ties into the importance of financial literacy and planning. So you mentioned planners and things like that. What since you take more of a holistic approach to identifying and structuring a plan for your clients, what what do you best recommend their starting point be? Like, beautiful example, we get this question a lot. What's your ideal client?
In my world, and it could be different for everybody, even in my position, because it just really depends on what you're focused on. Because the one fail that most salespeople have is that they try to be the masters of everything. And at the end of the day, it's inevitably you should try to focus on what you're good at and where you're really connecting the best. So, and it's funny because that kind of morphs over the course of time also, because as I'm getting older, so are the people in my generation. So it's like where at the beginning of my career, most of my sphere of influence and inner core were all first time home buyers. Now, being in my mid 40s, we're starting to deal with kids growing up and going into college. I'm now going to buy the bomb house versus the starter house. And you're starting to see a lot of like changes even in regards to my clientele. But in my world, I love dealing with buyers on the purchase side of stuff. I deal with clients obviously that are buying investment properties, and I do that analysis for them to figure out if that's a good move. But a lot of the business that I've done, and especially in the last few years, a lot of it has to do with the sale to buy, which in itself is probably one of the most complex things that you're going to ever do in your life, where it's like you're selling a house and then buying a house and you're trying to time it and you're trying to see what the end game is going to look like when the smoke clears. So I get a lot of that. That's probably what I'm seeing the most of. Second, and in a close second, to first time home buyers. But that's a whole now, the younger generation is that first time home buyer. So one of the things that all of us in sale have to do is we have to be relatable. I'm a 46-year-old man trying to relate to a 29-year-old. Like, it's a definite, there's a gap there. And a lot of what I try to focus on is listening and really understanding what and identifying what others have called the pain, which basically is what drives somebody or what their biggest concern is in regards to what they're trying to accomplish right now. Sometimes it's the payment, sometimes it's the out of pocket expense, sometimes it has nothing to do with either of those things, and it's something that's not even finance relatable. But what we try to do is we try to just pay attention and listen and just try to eliminate those concerns and provide them with enough information. But especially with the first time home buyers, what I love about that particular client is there's if I explain and teach these guys right and set them on a path which will inevitably lead to financial freedom, part of one of the pillars to sit there and get to that financial freedom is going to be in the real estate sector. So it's like I'm already starting to explain fairly early in our relationship, if they're so inclined to do so, what the parameters are to in buying investment properties and what you should be looking at and what a second home would be like and how all this stuff will play out and like how big of a house should you actually get versus like what you need versus what you want. So there's a ton of conversations that occur.
Now, you mentioned like the ton of conversations, but one thing I also realized, and I realized this on the real estate side, and you mentioned a lot, and we've talked about this plenty of times, is how what to look for in a lender, because there's people here who want to buy land and they assume that all lenders are the same. And as I've learned, and I think they're not all made the same way, or their programs are not the same way. So how do you identify, for example, Freedom Mortgage? What are they supposed to be looking for in a lender or in a lender institution?
Everything in what I this is an interesting question. This is a really, really interesting question because naturally, like I'm biased, like for the answer to that question to begin with. I have spent my career being solicited by the larger institutions out there that want me to come naturally and work for them, bring my production. But what I've realized over the course of time, when it comes down to it, lenders pay loan officers based on commissions. The client themselves never truly pay the loan officer. It's all part of what happens when this loan gets sold on Wall Street, securitized, and set to run where a servicer is stepping in and collecting the payments. So at the end of the day, most banks, after all the smoke clears, on most products are going to be in the same place. The key to really getting the best interest rate out there has to do with employing somebody that is paying attention to the market because it moves every single day. So when I'm sitting there and let's say the interest rate's the main focus to the client, which in a lot of cases it is, you're not necessarily going to pick a bank on day one while you're in the pre-approval process and they're going to guarantee you getting the best rate versus anybody, because at the end of the day, this market's moving. Like Chase might be better than me today, but I was smart enough because there were government reports coming out that had an effect on the market, which led rates to dropping. And like I gave them a rate on Thursday, which was better than Chase's Monday's rate. So when it comes down to it, the smartest way when you're interviewing a loan officer is you're going to have to put faith in somebody. And sometimes you're going to be right, sometimes you're going to be wrong. But at the end of the day, you should be being educated. More important than the cost of these things or the interest rates. I understand, like, when you don't know anything about anything, like, those are the two things you're going to focus on. But after you start to realize the importance, like how much is the value of somebody when you make a phone call on a Wednesday at 9:00 in the morning, what is the actual the value of you getting a return call within 25 minutes or not getting called back for 2 days? Like, where's the value in that to a potential person? Like, what's the value when you're dealing with, okay, I'm spending $45,000 out of pocket. $100 from one person is more expensive than $100 to another bank. You start to realize the value comes into the knowledge in the structuring of this, the advice you're going to get, the knowledge that you're going to, anytime you need this person, even after the fact, you can make a phone call if something happens. I'll give you a perfect example this week. I have a client that's having an issue where the insurance policy on the house, the lender is saying that there's something not right about it. We originated the loan. We sold this to another servicer. That servicer saying there's a problem with the insurance. I've done this mortgage. I have been paid. I am completely done. But that phone call was made to me from this client. And I have now spent 3 days trying to solve that client's problem. So what's the value in something like that? One of the things that you realize over the course of time, and your gut, strangely enough, usually gives you a little bit of a tingle in regards to recognizing this. We've all been on Earth long enough where you can kind of feel where somebody is swindling you, somebody is incompetent, somebody's not writing things down, somebody's not organized, somebody's telling you what you want to hear. You start to recognize these things. Whether you're going to believe them and listen to that tingle or not winds up becoming whether you're going to be one of those stories that sounds disastrous or one of those stories where it's like, this person's amazing. Always check the reviews on the particular person you're dealing with. Make sure that others have had good experiences with them. Always use somebody that's referred. Because to me, it's like, yes, you can just walk into your local branch of your local bank. You know nothing about nothing. And like, especially the huge banks, I mean, shoot, I can find 10,000 reviews that says Citibank's the greatest bank in the history of the world, 10,000 reviews saying that somebody should walk in and set that whole place on fire. Like, so you don't like it's the individual. All banks have really good people in them and really terrible people in them. And at the end of the day, like that's where you got to put your faith and your trust in my opinion. I'll put a little disclaimer at the bottom of that statement. But that's what I've kind of figured out over the course of time. If there was a bank where they would give unbelievable interest rates, unbelievable closing costs, and beat everybody all the time with everything, all of us would work there. But the playing field's fairly level. After 2008, when this whole financial crisis came full head and the federal government basically came out with Dodd-Frank and limited what banks could make and what individual loan officers can make, there was a point in time early in my career, you can come to me and I can say, hey, Rita, I'm going to charge you 3.5%. Knowing that I could get you an interest rate of 3.25%, but I can make more money for myself personally at 3.5%. Those days after 2008 ended. I don't make a nickel more by charging a client a higher interest rate. That leveled the playing field. That's why, like right now, the focus really should always be on the service aspect of things more than anything else.
Okay, so if we're gonna go down the service aspect, one of the things that's been very common in forms of the topic is the pandemic. I mean, we can't avoid it. It happened. It's happening. And one of the things that is the focal point from your industry and mine is people having a difficult time paying for their mortgage. So they're either putting it in forbearance or they put it in, what's the other one?
A modification.
Or they're doing reverse mortgages. How do you address issues like that when it comes to being in the lender or financial industry? Because those are real issues. I mean, someone bought a house in 2016, now they're out of work, and now they have to figure out how to pay their rent. How to pay their mortgage. Now, on an agent side, what we've been advising people, I know I have, is maybe they can rent out that place, or they can, talk to their mortgage company or their institution. But what is it like on your end, and how do you address those issues? I mean, let's be honest here. They exist. They're not going anywhere.
It's fairly painful on my side. Nothing makes me more heartbroken than getting or hearing these stories, completely understanding the position and dilemma that people are in, and really not being able to do things in a lot of scenarios. The second you wind up going in arrears on your mortgage, you almost get frozen from being able to do anything other than modify it, cut in which is kind of modification, but like you said, forbearance, which for those listening that don't know what forbearance is, it's basically kind of kicking the can down the road, where the lender will give you, let's say, 3 to 6 months of not having to make payments, and then backloading whatever you didn't pay on the backside of the mortgage. Or a modification where it'll be an extended period of time at a lower interest rate, and having to jump through the hoops in regards to doing and getting that accomplished. I get phone calls, and I have there's stories every single day with this stuff that a lot of times, unfortunately, keeps me up at night. But we're very limited on the mortgage retail side on being really able to help people get out of those types of scenarios. A lot of times my unfortunate advice to people is usually to sell, dust yourself off, don't lose the equity in the house, and start over. Not necessarily what people want to hear, but one of the things that I pride myself on, and I tell most of my clients this right out of the gate, and inevitably everybody throughout the course will realize this, is I don't sugarcoat and I don't play the hope game. I
No,
tell
you don't.
people very straightforward where things are at. I explain very clearly on how it works. Because what a lot of times happens is when you get these phone calls and they just don't understand how this stuff works. So at least if you understand that after you hit the ball, you need to run to first as opposed to run to third, it might not be what you want to hear, but it gives you some sort of sense of how to move or make the next move, as opposed to feeling like you're just running in place and stuck. I got off a phone call with somebody today where um, she's on disability, so the income is very limited. But she spoke to multiple lenders, and what she said to me was she keeps on going through this process and then they just fall off the earth and not calling her back. I spent about a half an hour today explaining to her how to qualify, what goes into it, and why these numbers and why she's not getting called back, and the things she can inevitably do to put herself in a better position to inevitably buy, or just change the strategy on where or what she's going to buy. And that had a positive impact on her. I didn't have exactly what she wanted to hear, but at least it set her on a path. And most people, nobody likes getting bad news, but everybody loves a plan. So when it comes down to that, what we were just talking about, where you're in default, what I try to do if I can't help somebody, at least I give them a plan and knowledge and educate them as best as I can on what to do, because everybody's circumstances are different. Some people were restaurant workers where they were closed down and they're behind, but they're working and now they're like just scrapping to get caught up. That might have one impact on the advice I'm giving somebody versus somebody where they got hurt on the job and they're waiting for a settlement, or they're waiting for, long-term disability to kick in and they're trying to like make ends meet, but they're going to wind up being on a fixed income. You get so many of these stories, which I have to really wrap my head around before I can even advise them. A lot of times I can't necessarily personally help them, but at least I can set them in motion to try to get help from somewhere. I hope that answered your question.
It does, but I have a follow up to that. And this is like mentioned. You mentioned the people on fixed incomes, and that includes retirees. That includes people who are on disability, either short term or long term. One of the things that's very common for them is the topic of reverse mortgages. Obviously, that is a topic in your industry as well. So, what is a reverse mortgage? Why would people consider it? And what factors should they consider instead of what they're actually thinking about? And what kind of people would get something like that?
I hope what I'm about to say doesn't offend people, because I loathe the reverse mortgages. In my world, I hope this isn't an insulting thing to say, but I'm going to say it anyway. If you're in a position where you've gotten yourself where the only option you have is a reverse mortgage, you've literally pretty much done everything wrong. And as much as I hate to say it, there are exceptions to the rule. Trust me when I say that, where sometimes circumstances have put them in this. But what happens with the reverse is why I absolutely despise them. It's fine for the person taking the reverse, and for those who are listening that don't understand the concept of reverse, what they're doing is the bank's literally paying you back with the equity of your house. So if you sit there and you owe $300,000 on a $600,000 house, every month you're not making a mortgage payment. They're paying the taxes and the insurance, and they're giving you money, usually on a monthly basis, eating into that equity, which is fine for the person that actually is taking the reverse mortgage. But what it does is it leaves a disaster for the legacy, for the people that will inevitably inherit the house. Because mind you, reverse mortgages aren't being done on 35-year-olds. These are being done for seniors that are in a position where they are having cash flow problems and they don't have any retirement, and everything is buried literally into this house. So the end result winds up being that inevitably these people, go to a better place, and the children are given this house and have to deal with the ramifications of the complexity of all of everything that has to do with this person's estate and the house in the reverse, and then the reverse companies wanting them to refinance out of it, and it's a lot of times it becomes very, very, very problematic. I don't love them, as you can probably guess from the segment. I really, really try my best to give people other options than taking a reverse. One of the things I do proactively that has nothing to do with anything other than giving friends, family, colleagues, and clients insight is trying to utilize home equity lines of credit and setting those up prior to retirement. If you know you're going to retire and you have equity in the house, trying to situate a home equity line of credit, because what's really cool about those is you only pay interest on money that you have drawn against that line, but it serves as a safety net for 10 years for you. So if I'm retiring at 65, I'm 64 years old, I open up a home equity line for $200,000. Let's say they give me an initial $25,000 that they force me to take. No problem. I take the $25,000, I pay it back the very next month. Maybe it cost me $50 or $100 in interest. Now I have the safety net, which is zeroed out. I have checkbooks to literally write a check out of this anytime I need it. And it serves as a safety net if things start getting tight or I start getting in trouble. Like, I can lean on that as opposed to the reverse mortgages. The reverse mortgages are so astronomically expensive. But once again, most people aren't focusing on these things because you're not paying anything. But at the end of the day, who's going to wind up? Most moms and dads, most of the time, don't want to do things that are going to be detrimental to their children. This loan officer's opinion is reverse mortgages are fairly detrimental to their children.
Well, part of the reason why I'm asking that is because I am the next generation. Worst kept secret is I'm a millennial. So technically I am younger than you. So, so as a millennial, we're hearing that, we see the commercials all the time. I mean, about, are you retired? It's going to sound really like an infomercial right now, but are you retired? Are you over the age of this, and this? Think about getting a reverse mortgage. And for people who are, as you said, who are stuck or who are nervous or their kids really can't provide, or they don't want to burden their children, which is what we hear a lot, they try to do it on their own, and it piles up. So while I have you here, I really wanted to ask that question. And another question I am just like itching to ask is actually about what's that thing called? How do you address, the topic of FHA? People go, well, if it's an FHA loan, I said, technically it is, but technically it isn't. So how do you explain that to someone when they look at their bill or they look at their mortgage and they see FHA, but they'll see Freedom Mortgage or Wells Fargo or something like that? Like, how do you explain that when they get that first?
Okay, so the first part of it being once again, we're talking about the reverse side of things. The strange things that I've realized about reverse mortgages is that I feel like, strangely enough, it's more of a generational thing. Like right now, the seniors that are taking out and have the ability to take out reverse mortgages are all part of the baby boomer generation. And it's funny, I'm Generation X, you're mentioning the fact that you're a millennial. Like, we're seem to be less tied to our houses than, in your case, probably your grandparents, in my case, probably my parents are tied to houses. So what's funny to me is inevitably, I think we're going to see less of that being an issue. Because why people get into reverse mortgages, and mind you, we're talking about seniors, and people are sitting there where a lot of us, regardless of how old you are, most people don't conceptually think about when they're going to die, as morbid of a conversation as this is turning to. So it's like I'll sit there and I'm watching somebody at 69 years old getting into a reverse mortgage and trying to basically keep a 5-bedroom ranch, and they're living by themselves. That's just not intelligent, like economically speaking. Pragmatically speaking, it just doesn't make sense. So these people are literally creating a reverse mortgage to stay in a house that's way too big for them, that they don't need, that they really should. If we took all emotions out of this conversation, you sell, downgrade, and put yourself into something where this is going to be more intelligently structured than taking a reverse mortgage. And I see that all the time, because that 69-year-old, hey, I might live till 90. Correct, you might. I don't know if you're planning on marrying and adding 6 children to fill that house, but that generation has been so super tied to houses. I'm dealing with it firsthand with a mom that doesn't want to leave, where she inevitably has been, where she raised the kids and has been for the better part of the last 30 years. I get it. I get the emotional side of it. But earlier in this conversation, what I told you, and this holds true, you know this to be true, I don't sugarcoat things. When you guys are listening to me speak on this, it's not that I'm being heartless. Trust me, I am a very emotional person and I love people. So I can understand and appreciate the being tied to a property and like the emotional aspect of it. But when it comes down to it, I watch too many people get into these reverses where they should just break off and just inevitably sell the house. Perhaps it's a little bit different from my generation and your generation, because it seems like we're more inclined to buy something, stay somewhere for a bit of time, buy something else, stay somewhere for a bit of time. Like we've been almost groomed to move and shift, versus my mom's generation, where they don't do that. It's like we're here, we're going to burn the mortgage after it gets paid off, and we're going to get to that end, but it's like instead we're going to refinance and cash out 50 times over the next 20 years, and like that's kind of been that mentality. So I think inevitably, as we kind of press forward, we'll start I really do feel that these next generations are going to lean on reverse mortgages far less. That's that part of it. Every reverse mortgage is an FHA mortgage. All FHA is a glorified government insurance. They're insuring the loan. So if somebody defaulted on that loan, the FHA steps in and they start paying the bill until that particular house winds up getting sold. For banks, nothing safer than an FHA mortgage. So banks clearly like them. It's got its pros and cons. The pros to FHA is low down payment. You very forgiving on credit mistakes or low credit scores. But the trade-off is their mortgage insurance, if you're putting less than 5% down, lasts forever, which I think they really did. It used to not be like that, but I think they did to incentivize people to inevitably try, if they're going to stay long-term in a house, to inevitably refinance into a conventional mortgage. They pool money. So there's 2 insurances with the FHA. There's the upfront mortgage insurance, which they collect at closing that gets financed, 1.75% of whatever you're borrowing, and then you have to pay the monthly mortgage insurance. The logic on the FHA is 1 out of every 5th loan is most likely going to default, and then they have this pool of money which is going to literally support that house until it gets sold or foreclosed on, however it's going to wind up taking its course. So that's the pros and cons on the FHA side of stuff. They're a little bit stricter on some of their aspects, but generally speaking, it serves a purpose. and a really good purpose. And it has allowed millions upon millions of people that possibly wouldn't have been able to buy houses utilizing conventional loans to inevitably buy a house. But the reverse mortgages are all FHA mortgages. It is government backed.
I did not know that.
Little. Oh, I'm glad you learned something here.
Yeah, you learn something new every day. Now, just to try to make this a little bit more of a happier thing, you mentioned my generation and your generation. And given the fact that you just, no offense, I love my mom to death, but she is older.
I hope so.
She's, a lot of her generation, they are retiring. So how do you address, or what suggestion would you make for someone who's kind of had like a family home for generations? For example, someone whose grandparents had it now got passed down to the boomers and Xers, and now it's gonna, like, the millennials are gonna inherit it. So what suggestions would you make for people to either buy out their families or address topics like that? Because you mentioned multiple times in the beginning about, addressing the holes in certain things in the process of things. How would you address that process, especially people who've lived in the same house for, I want to say, 60 years?
It's always about communication. One of the things I'm starting to realize, because I'm seeing more and more of this, as unfortunately that generation we were talking about, of baby boomers, are, they're starting to run their course and life ending, and what's being left on either to the spouse or the children. And what I'm starting to realize is the lack of communication in a lot of these cases. I'm seeing this constantly. So everybody's situation is going to be different. So mom's situation in your case is going to be different than mom's situation in my case. So that needs to have an analysis. And really what it comes down to is families coming together with elder care attorneys and really starting to formulate plans and creating trusts, and really trying to formulate what the end game is going to be with all of this stuff. Because I unfortunately lost my stepdad this year, and I've watched my mom for 4 straight months killing herself to really put all the pieces together in regards to how he himself had things structured. And he just figured, all right, I leave this world, they'll figure it out. But it's like, that's not a very good strategy, because she literally, beside the emotional baggage that comes along with losing somebody that you love and that has been part of your life for all these years, that is basically your right arm and now is gone. Now you leave them this terrible pile of awfulness in regards to following paper trails on things and trying to sort things, where you have these very heartless companies that don't care. They find out somebody passed away. It's like, all right, that account's now frozen. All right, now you have to deal with the courts. All right, now you have to deal with Medicaid or Medicare or Social Security. And there's a million of these things on top of what we're talking about, which is the housing part of it. So my recommendation when I'm having these conversations with people is transparency. It's like, I understand you came from this generation where everything was top secret, but those days should be gone. I'm the man of the house and my wife serves her purpose but shouldn't be part of any of the financial discussions is archaic and ridiculous. It's like, have conversations with your parents, understand where they are, get them to hopefully talk to planners and attorneys that will better position. Start moving assets now. I talk about this all the time because this is something that almost infuriates me, where I don't understand why, if you have money earmarked for your children, why they can't get that until you're dead. I don't understand that. It's like, and this, I'm not talking about giving it to your children at 18 years old. I'm talking about giving it to your 50-year-old son. who has a job, his own family, and he's structured. Why do you have to wait until you die where you can't even appreciate the fact, well, like, you can structure plans and put yourselves in position to do things so much more intelligently and simplify it just by having those conversations. I get it. Sometimes they're morbid and they're tough, but it's something that I'm seeing a lot more of as I get further along on this stuff. And I beg people to start having these conversations to avoid a lot of the problems that I've seen firsthand or even have seen in my personal life. So that's your best answer to that question is communication, communication, communication. You have to start forcing those folks to start talking about this stuff, even though they don't want to.
Now, you just mentioned something about the topic of money. I've noticed in real estate, I noticed in real estate, people really don't talk about money the way they used to. Growing up, when I was a kid, that was something you discussed because, one, you needed to learn what to do when you become an adult, or at least have an idea. I mean, everyone doesn't know everything because times have changed. But two, you get them comfortable. I've noticed that the topic of money is a very taboo topic in a lot of families. Why is that?
I think a lot of it, and this is more on the opinion versus any sort of factual evidence to it. I think a lot of it has to do with the disparity that society is now created, and how the space between the rich and the poor, and the fact that you don't want to show your hand because you don't want people in your pockets. So I'm starting to see a lot of that also, and it's so. I mean, I know I'm broad stroking this stuff, and it's shame on me for even doing that. And I know just for the topic of this discussion, I'm doing it more for the fun of where this conversation takes us. But that I see a lot of, and people basically pass judgment on certain things, like wow, that guy has that much, so much money, he should be doing this, and he's not. And it's a lot of people, they need to put up that wall because everything's under a microscope. I think a lot of what you're talking about, social media is having an impact on, where everything is, instead of being transparent and in the open, has become far more secretive because you don't want the world to turn on you in a lot of cases. So I kind of am starting to feel a lot of that happening. But on top of it, it's going to hurt us because those conversations need to happen. And one of the things I always laughed about when it came down to college was, I don't need to know how to build a space station on Mars. I need to know how to budget. You know what I mean? And it's I don't need you to set up 12 booths for credit card companies to grab an 18-year-old to make them open up credit cards. We don't need any of that stuff. So it's the fundamental problems that exist in the topic that you just mentioned really needs to start on the very basic stages that have to do with managing your money, understanding what credit, the importance of credit, how that's going to affect what goes on with student loans, what the impact of deferring student loans are. These things should be college courses as in your freshman year. I don't need to necessarily learn or be taught some of the things that they teach you as your fundamental basics, when it's this is in the world the most important thing, and it's absolutely positively neglected. But if those sorts of courses were mandatory either in 12th grade or in freshman year of colleges, that would start to solve your problem in why people aren't talking about this stuff.
That, speaking as someone who also went to college, it would have been nice to have that in my freshman year. I mean, looking back at everything now, I really am glad I took a business class. I took, financial planning because they offered that in the school I went to. But I had to wait till my sophomore, junior year to have that. And I but also it's down to the fact that I think that the family that I do have and the people that are around me really are comfortable having that conversation with me. And I do agree with you that, understanding the foundation and understanding how money works is incredibly important. And I'm also seeing that I think we're seeing the consequences of not having that conversation.
We're definitely seeing the consequences of that and it's running rampant, especially in a society now. And I am just as equally as guilty as everybody else. And we talk about this. Me and my friends talk about this stuff all the time, and it's funny because you always resort back to like when you were young and your parents were telling you that they walked to school 3 miles both ways uphill, and every day there was a blizzard. Like we're starting to become those people now where it's like when I grew up, I had 4 TV stations and I went out and played. And now these guys, like my kids have absolute mental breakdowns if they don't have their iPads, and they have no appreciation. And we're in a society where I can just literally get anything I want delivered to me immediately. I can sit on Amazon. I do it just like everybody else out there probably does. I sit and woke up this morning and I thought to myself, hey, I really could use another attachment to my hose. And 5 minutes later, it's like, Jason, it's being delivered to you. Thank you. And so this feeling of immediate satisfaction is also driving what we're all doing. And as good or as bad as that is, this also has a major effect on how we treat money and how our expectations are and that we want. And I'm having a real tough time, especially in a market. Right now, the housing market, people are tripping over each other. We have a supply and demand issue, as you know, Rita, where the supply is low and the demand still remains high. And I have first-time home buyers stepping over each other to outbid each other. And when I'm sitting there and trying to have this intelligent conversation with people, being like, what sense does it really make for you to spend $75,000 more than what a house is worth? And what I keep getting as an answer is because I want it. And that is a microcosm of the problems that I'm starting to see out there when it comes down to doing things, when it comes down to economically, intelligently. It's right now we're being trained, and the younger generation really is being trained because they have nothing else to even compare it to, that when you want something, you have a right to want that and you deserve it and you should get it. And it doesn't matter what the ramifications are of it. Because you want it, you should go get it. And a lot of times I'm having these conversations where it's like, you're living right now under your parents' mini mansion in 2,000 square foot apartment. And just because you want to go buy a house right now, it doesn't mean that that's the most intelligent thing to do. The people that are sensible, that have these discussions, don't. The people that are not necessarily caring about what I'm saying, they're buying houses for $70,000 over what they're worth. That never to me seems like a good idea. I try my best to, even though it's detrimental to my own business, I still, because I am more inclined to protect people than worry about a commission that I might be making, I have these conversations with people and I try to be the angel on their shoulder telling them this is not a sensible thing to do. But this is all part of the direction that our country, our world, our society is heading towards. And once again, it's something that I don't necessarily think is really the best way to do things if we're talking about sensibility and economics.
Mm-hmm. Wow, we have a lot. I mean, that was that. we covered a lot today, didn't we?
We definitely did. And like, I hope a lot of people understand like most of the things that when I'm talking about, like to be able to decipher the factual part of it versus the opinion part of it. Like a lot of what we discussed, obviously, like really is my opinion on things and not necessarily
Well,
should
here,
reflect like as how it is, like
no,
this is just what I'm seeing.
no, I understand that, but the reason why I really wanted you on here is because you are honest and you do communicate about the things that people really are interested in. Like, how do I address the topic of, my mom is retiring or my dad's retiring or whatever, and I'm doing well, and I don't want them to feel like it's an issue, or the topic of reverse mortgages, because you and I see social media, look at social media all the time, where we hear about what's going on, and you have people with posts on Instagram about business credit, and you can buy a house with business credit, you can do this, you can do that, or they'll talk about reverse mortgages like you're picking up a slice of pizza, and the process does not match the advertising. And if we don't discuss what that entails, we're going to keep having these issues. So I'd rather us discuss the real, problems, well, not problems, but the real concerns people have, than, well, everything's fine now. No, everything has a process to it. And, they hear real estate agents all the time, and real estate agents go, well, of course they can do that. But if they can't handle something, it is our job as agents and as lenders to let them know that. So if I had someone who, not a client, but someone who came to me last week asking me they want to buy a house. I'm like, okay, so here's the process of buying a house, and da da da. And I gave them your information, but they were frustrated because they wanted to buy the house without buying a house. I'm like, how do you do that? Like, are you stealing the house? Are you what are you trying to do? He says, well, I saw on Instagram, which is the thing that bugs me. So I saw on Instagram that you can buy a house without buying the house. You just notify the landlord that you want to buy the place, and you pay the landlord. But one way or the other, it requires money. So either you're buying it on the front end or you're buying it on the back end, but you're gonna pay.
That's a foregone absolute.
But you'll be surprised. And then they'll go, well, if I just, leverage my house, I can buy this. I said, but is it a need? If it's not a need, don't risk your personal assets for something that is not a focal point. Another thing is, and you mentioned it as well, the long-term impact of buying something. You're going to have some of these people have kids. Some of these people just got their jobs after, not working for a couple of years. How are you addressing those issues? And this is something you and I have had plenty of conversations about what happens after they buy. And usually after they buy, the agent goes, okay, I'll wait 90 days and then call them and say, do they have anyone? I said, okay, that's great, but they just trusted us with basically their livelihood in a way. And the best you're gonna say is, does Greg the mover want to buy a place? No, you want to make sure that they understand what they're getting into, but also you want to understand that you're there for them. And why you're such a unique situation, or a unique lender to me, Jason, was the fact that you do address those things. I've referred clients to you in the past. Some of them said sure, some of them said no. And one thing all of them say is, at least he's honest. So that way I know what to do going forward. If we're
I,
not having those conversations now, once again, we're going to keep having these issues.
I've never seen somebody wing it have better results than somebody that plans for it. So it may happen from time to time, but generally speaking, I always am going to lean, and I talk about this a lot, which is suitability over eligibility. So it's like I can structure a mortgage plan where on a Friday you can't afford to put a pizza on or a topping on a pizza, But at the end of the day, that to me is irresponsible. So I don't necessarily all the time look at solely the eligibility things. I look at the suitability. I want to put people on a path for success, and I don't want to have them be a statistic down the road. There's always going to be situations where external forces are going to cause things to happen that I couldn't foresee. But generally speaking, it should never be me putting somebody into a loan that they continue their pace with how their income is and the money coming in and trying to make ends meet that leads them to inevitably falling apart and either losing their house or being put into an absolute detrimental situation. That was irresponsible on my side and not recognizing it and not doing my due diligence in regards to preparing them for it. Sometimes it happens because the client themselves do not listen to me, where I tell them that, like, hey, listen, you're biting off more than you can chew. You're on a fixed income. This is not sensible. This isn't intelligent. Like, you really need to try to find something more affordable, or this could wind up being really detrimental to you. And most of the time, people will listen. Even once again, if they don't like what I'm saying, they will at least listen and understand. Some people where it's that same mentality I was talking about earlier, where it's I want it, so I'm going to get it. I'll figure it out, and that usually turns fairly terrible in a lot of cases. When I'm doing my breakdowns, I'm looking at certain things like income growth potential. So I might have a police officer in year 3 where he's going to hit max pay at 5.5 that he's stretching himself. Or he's married to a teacher where incrementally she's making more money as time goes on year over year. Okay, I'm more inclined to stretch them a little bit if they want to be stretched, because I know inevitably they're going to get into a position where the money's going to be there. But like you mentioned, I can also do a mortgage for a fixed income on Social Security with a pension. I know nothing's changing in these people's worlds. So am I more inclined to stretch them? Of course not, because I know that I'm in a position where they're not going to wind up getting more money. But I'm also asking other questions like, are people going to be living with you that are going to contribute to this mortgage that I'm not seeing? Because maybe they don't qualify, or they are in a cash business or self-employed and they're not claiming a lot now. Like, there's other factors I'm going to do in my assessment, which is going to help me make a decision. And of course, because I've been doing this for so long, I can see what the results of a lot of these things and a lot of the advice I've given people. So it's not like I don't have any sort of backing to rely on. I understand where that line's drawn. Beside the fact that society and the banking department and the Fed have all understand based on statistics set these parameters. And guess what? They kind of got it right. They know where that line's drawn, where you go in your debt to income ratio and you exceed a specific percentage, where the sharp decline in people being able to afford that property occurs. And this is 50, 60 years of statistics. So they know where these lines are drawn. So they got it right. I feel like they really do have it right. But now, like, we play inside of these parameters, and I have to take it that next step as a lender, as a loan officer, to make sure I stay within those parameters and make sure people are staying within inside that suitability over the eligibility.
Now, okay, so I'm going to ask a question. It is going to be an uncomfortable question, but if I don't ask it, I'll never know the answer. One of the biggest topics this past pandemic is how you mentioned the buyer part, where people are asking for mortgages and things like that. But this, in forms of the seller part, you also mentioned the changes in the market. If you know, as a lender, And I know as an agent that right now it's more of a, let's put it in safety sentences, a seller's market. How do you address that with the client? Because I feel like on my end, it's they want it so badly, they're not seeing the long term effect of it. So I live in New York. We both do. New York's not cheap. New York is expensive. So if someone's buying something here in New York and they think, let's say they're buying a studio in, let's say, the Northeast Bronx, okay, and they bought a studio in the Northeast Bronx and they bought it for 250. I think in my head, for a studio co-op or condo for 250, I think that's ridiculously high, especially if it's not, if the on a normal day it'll be at least maybe 170. How do you address the, their anxiousness plus the influx or the change in the market?
I would say in most cases, my problem solves itself. Because what happens is in my world is in lending, it's not based on what somebody is going into contract and paying. It is based on what it appraises for. So if I have that situation where, let's say, somebody's buying a $250,000 co-op, and the co-op requires 20% down, but that co-op only appraises for 200, I can only lend somebody up to 20% less of that 200. So in that case, this scenario, it's $160,000. So if they're buying it for 250 and I can only lend them 160, a lot of times like that's straight out of the gate that they don't have enough money to actually satisfy it. Where it's like, okay, I don't even have the ability to get to the point where I'm putting down $90,000 on this to make this work. So that's kind of happens a lot of times. And a lot of the other thing is most people don't like being beat. So people, even though they go into it and they get crazy in the negotiating process, and even in the contract process, unless the contract itself is specifically dictating that regardless of what this thing appraises for, you have to buy it at this number, there's usually levels of protection inside this. So inevitably what winds up happening is the buyer comes to their senses a lot of time and realizes that they're not going to overpay if there's not such language in the contract. And I've had this happen quite often recently where the house appraises or the condo or the co-op appraises so considerably less than what they're buying it for that it kills the deal, and that person the buyer gets their down payment back because there was no verbiage inside the contract forcing them to have to buy it regardless of the value of it. But what's been really interesting is a lot of people are playing that game where it's like, I'll just offer whatever the heck gets me this deal, and then I'll renegotiate it after the appraisal comes in. You're seeing a lot of that. But
that's true.
But sellers are the agents have a major impact on a lot of this. The better agents are having these conversations with people and setting expectations with their sellers. So if you do run into these problems, this is happening, versus the not so good agent who's once again doing what I have a problem with on my side, and that's telling clients what they want to hear. And now they have basically set them up for failure, and they have created expectations on something where, what's been happening a lot lately is these deals have been falling apart, and then the seller comes out and lists it for even higher numbers.
Really?
Craziness. And you know what the craziest part about this is the definition of idiot, which is doing the same thing over and over and expecting different results. So like these people, to me, in a lot of cases are absolutely insane, because why do you think anybody's going to feel okay with overpaying for your condo or your house, or, based on where market is? People are willing to go above. Don't get me wrong, but they're not willing to go 10 to 15% above, and that's starting to get into crazy numbers. $500,000 house for 15% above what it's worth. It's like, it's not the only house on earth, guys. I understand that you're in low inventory, but like, honestly, once again, detrimental to mine and your business. We need these people to buy houses. We make money for doing that. But there comes a level when it comes down to work ethic and ethics in general that I can't support somebody doing something that ridiculous. I have to say something about it. I will do your loan if we can make it work, if you're so adamant about it. But I will tell you that, in my opinion, it is absolutely insane.
I wish I can put that as a ringtone. Because I try to explain that, and it goes into, well, according to Trulia or Zillow, or I heard from this guy, or, that you can do it this way. And I'm going, that doesn't make any sense, because you're essentially saying that you are trying to lie about the market, and you can't do that. The reality is this. So it's the manage expectation part is really the struggle right now, because I always tell people, and I said this to you, and I know you do as well, because I got it from you. So let's be honest here. This is one of the things I stole from you. That the important thing is to manage expectations. So if you're taking out if you're pre-approved for 160, please don't think you're going to get a $300,000 condo, a co-op, or a house. No. Basically, the bank is telling you we're willing to invest, or the lender is trying to tell you they're willing to invest this much into buying your thing, because you are the asset. They're not, I try to say the best way I can basically say it, which is not entirely perfect, but is the best way to explain it, that banks are really in the investment business, not in the real estate business. And they'll do what they can to get a return on their investment. And when I say it that way, it shifts the conversation. So now it's no longer, I want to buy this place that's really out of my price range. It's now going, okay, what can I get with this?
Smart. It's a good strategy. It's a good piece of information. And what you're doing is you're taking them to looking at something at a different perspective, which is the important part of it. I get that a lot, where here's another example. You're buying $1 million property. You're putting down $900,000. You need to borrow $100,000 from the bank, but you don't have a job. What do I get every time that scenario comes up? Jay, there is no risk to the bank. I don't understand what the problem is. Who cares how I'm going to pay for it? I'm never going to get foreclosed on. It's like, you just said it exactly right. Nobody in their right mind with $900,000 of equity in $1 million house is ever going to allow a bank to foreclose on them. But if you start missing payments, the bank has no choice but to spend the money to start their process to do such a thing. So it's time and effort and energy. Banks want to lend people money, collect interest. It's simple and it's easy. They don't want to foreclose on you and go through litigation and put motions in courts and deal with their legal team and pay somebody to do this. This is a perspective that, when I explain this, gets the, oh, wow. Yeah, I never thought of that. Because they're thinking that there's no risk to the bank, and it's the polar opposite. It's complete risk to the bank, because you're taking something that should be so ridiculously simple for them, and you're making it so complicated, and they know you're never going to let them foreclose on. So you're going to take them all the way down this line. And in New York, we know it takes forever. This could be a 2 or 3 year headache for a bank. And it's like, why? I don't have a job, so like there's no risk here. Well, there's your risk. You're doing something like, nobody wants to open up a restaurant and sell gas. You want to sell food. Banks they want money. They want to earn money on money. They want it to be simple. They want you to send them their payment every month, and that's how the system works. So that's why, like, when you put it into that perspective for people, it changes the way they look at it. And that's what you're doing. You're changing the way they're looking at it and putting it into a position where you're putting yourself in somebody else's shoes and making it so it's understandable on something that you could easily have missed thinking about. But that's my job and your job in a lot of cases. I give perspective on things that they're not looking at. They don't even know to look at. And that'll change the game in a lot of cases.
Which and when you were mentioning things about, the importance of the collaboration between the agents and everyone and all that stuff, I feel like that all ties into it. That if they understood that process, was which we've been discussing this entire time, I do believe in my gut that it will change how they view their credit score, how they view their pocket. They might have a little more confidence to ask for that raise, or they might have a little more confidence to look at their money differently, not necessarily with someone that can just buy a house, but can view themselves as the quote unquote investor, and discussing reverse mortgages is important to that conversation. Discussing retirement is important to that conversation. Discussing long-term spending and trust are important to that conversation. But once again, I'm a real estate agent. So when they see me, they kind of go, well, she's going to sell me the world. So having people like you, I mean, we also have agents that come on here all the time, so that's not new. But having the lenders and the managing brokers and the, appraisal people, really discuss these things, the objective is to change that conversation. So when you do have a client who hopefully listens to this, they understand now that this is more than just, oh, I'm just buying a house. No, you're not, bruh. That's not entirely true. It's more to it than that. I do have one quick question, and this is mostly a personal question, and I get this question a lot. What do you do? How I do it is different than everybody. But sometimes I get questions that people will call and say, "What do you have that I can pay like $1,000 a month?" And I said, "What do you mean by $1,000 a month?" It says, "Well, I want to buy something." I said, "Okay, are you pre-approved?" Which is usually my question before I go any further. And they'll go, "No, but I just want to see what you have in like the $1,000 a month range." I'm going, "Well, this isn't a rental. This is you're buying something. For a rental, I can see that topic, but when you're buying something, normally you can't. We don't measure, at least on our end, we don't measure, because after the percentages, I mean, after down payment and after all that, you may not be end up spending $1,000 a month. You may be paying $1,400. We don't know. You may be paying less. So for us to say, what do you have in this range, is not even realistic. So how do you address that? Because I know how we address it on the real estate end. How do you address it on the lender end? And I know you probably rarely get that topic, but I do have to ask it.
No, I actually get it a lot where it's like that's what we call the cart before the horse. And it's like inevitably I have so many easy bullet point rebuttals to that where it's inevitably the person either gets frustrated, moves on, and continues to ask that question ridiculously to other people, or they obviously start to realize that you have to do an analysis before you can ever figure that out. So because the fact that putting 20% down versus not putting 20% down requires mortgage insurance or doesn't, how much the property taxes are, if you're buying a condo versus buying a co-op, some of these things have maintenance, some of these things have homeowners association dues, some of these places are going to have higher insurance, some of these places are going to have lower insurance. It's like, if we're just talking about principal and interest, I can tell people every $100,000 is about $450 a month. So in your case, you want to spend $1,000 on just principal and interest, then I can tell you you're going to probably be borrowing somewhere in the $200,000 to $225,000 range. But most people aren't just talking about principal and interest; they're talking about their total payment. That's when it's like you start to say these things in a kind way, but it starts to so clearly show how ridiculous of a question that is. because there's so many factors. It's like, what type of mortgage product are you doing? What's your credit score? What's the impact of that interest rate? How much money are you putting down? Are you incorporating your closing costs? Like on and on and on and on. And then it's just like, oh yeah, Jay, I get it.
Oh yeah, Jay, I get it.
You can't ever get to that point where like, oh, if I buy, because I get that too. Like, Jay, how much can I afford? Like, oh, gosh, like everything in the lending side is how much you can afford on a monthly basis. And then it transitions into what that's going to be based on those things that I just went crazy listing. So like when somebody's like, Jay, I just want to know how much of a house I can buy. It's like, that's such a ridiculous question without being able to analyze it, figure out how much they can afford on a monthly basis, and then what that translates into. Because if I tell somebody they can afford a $400,000 house, okay, where? Suffolk County, Nassau County, Queens, Nebraska? I mean, taxes on property are different everywhere. You know what I mean? So it's like that payment's going to be different. Like, okay, now you want to buy in Nebraska. Do you have a job in Nebraska? Bank's not going to lend you money if you work in New York with the, I'm going to get a job. Like, that's not going to work. All of these things play into it. So inevitably, when it's just the same exact thing when somebody calls me up and says, hey, Jay, I'm talking to banks. What's the interest rate? I mean, I can't tell you that. It's like, it depends on how much you're putting down, what's your loan product, what your credit score is, where you're buying, what type of property you're buying. Like when I get that question, I actually kind of like get excited because it's like, oh, nice. I got somebody I get to educate because these people know nothing. If they think that this is the question to ask second one to a lender, they know nothing. And I can show them and give them such value that regardless of what this inevitably transitions into, these people are going to be clients for life for me because now I get to shine.
You know, you just mentioned something about like Nebraska and everything. A lot of people are working from home. I know eventually we got to like end this conversation, but you know, when you and I talk, we have a problem. So people are working from home more. So let's just say, for argument's sake, I've decided to move to DC, which is where I used to live for a while. But I work in New York State. I mean, I work in New York City, clearly. How do you address that? Do you address the taxes based off of where I'm living, where I'm moving to, even though I'm working from home? Or is it because I'm technically working in New York gets factored in as well as DC?
Well, what winds up happening is the first thing I have to see and find out and get from HR from that company is that you're allowed, like you'll still be employed if you do make that transition, and they'll allow you to work from anywhere. Then it's a matter of like anything else. It's like I am qualifying people based on where they're going to move to. Even from here, like county to county is different because the property tax is so drastically different. The first thing, like, because I get that too, where it's like, hey, Jay, I'm thinking about moving to Virginia. Well, Virginia's a really big state. And the taxes in Richmond, Virginia are very, very different from taxes up in Old Town, where it's like closer to DC and in the
Fairfax
suburbs. So it's like if you're going to be in Arlington, it's super different than if you're living in Culpeper. So all of this stuff kind of plays into it, where I try to zone people into first where their budget's going to be on what they can afford. Then I start to kind of zone into sliding scales based on, okay, if the taxes are this and the purchase price is this, then this is what you can basically afford. Every $10,000 you go up in price will get offset by $600 you come down in taxes. And I start to kind of give them a moving scale for them to, at least while they're playing online, figure out if this is something that is going to be in their wheelhouse. Naturally, when they like something, they can always resort back to me where I can make sure and double, triple check that it's going to actually work. but it is a very good question and something that I'm dealing with constantly as I'm educating people on how to zone them into what the right price range is in wherever they're going to wind up looking. And a lot of people try to do things way too broad, where the first function of me, after I kind of figure out their numbers, is to start pushing them to zone into where they're actually going to be looking and where they want to be. We can't have a 3-state target. Yeah, Jay, I'm looking in New Jersey, Pennsylvania, New York. No, that's not going to work for me. You're going to qualify differently in all 3 of those states, in all of the individual counties. You have to start to zone into where. It may wind up changing, and it might not work after we figure it out, like in regards to where you want to be, but we got to start somewhere. And I start to push to force people to do that. I don't even have to really force as much as the real estate agents, because people like you, Rita, like obviously want to go and show them and start setting this up. It can't be that broad. You have to start zoning them in.
Actually, same here. You know, I am on social media, and I think a lot of people are. And the one question I get a lot is, "Oh, I want to move to New York City." Okay, where? New York City. There are 5 boroughs. Which one? Okay, Manhattan. Where in Manhattan? So there are roughly 30 different neighborhoods in Manhattan alone. So, I mean, we try as much as we can. I think the struggle is that when it comes to real estate, they kind of McDonald's versus, that it's a process. And even in McDonald's, it's called burger. But, they'll go, well, I'm looking for a 2-bedroom 3-bath with the side of walk-in. Where are you looking at this stuff?
Right.
So, and like I said, this is why these conversations are important. And I feel like we're going to have more of these conversations again. So be open to another visit.
100%.
And, but before we end this real quick, I do have to ask, do you have any advice for people who are looking into that whole getting into real estate, the purchasing land? What's the advice would you give people?
You cannot start early enough in having conversations with the me's of the world. Like, ooh. You want to, and I tell people this, like, you're talking about ideal. You start talking to me 3 months in advance. I can perfect it. I can educate. I can get you to maximize your position, like right out of the gate, as opposed to me trying to solve problems during the process itself. The further ahead we are on things and the more prepared you are, the better.
Okay.
So I always want to have these conversations. Now, one of the challenges that you're going to run into when you're just trying to buy land and then build something on it is very hard, ridiculously hard to find lenders that lend against land these days. Your ideal option is to buy the land cash. And then when you do the construction loan, the land that you purchase will serve as the down payment portion of it, because obviously land has value and the structure itself will have value. And naturally, the structure will never be 100% of the value of it. So like what I tell people to do is save up enough to buy the land first, then start to figure out the plans, be it the architect plans and the construction and the contractors or / builders, and like what you got to do with the town to obviously make sure that you're going to get your electric hookups and your water hookups and what all that looks like, and roads. There's a lot when it comes down to new construction. But once again, well-versed in this stuff, systematically you go about it. And if you get ahead of it and you can sit there and formulate your game plan and implement that plan, it'll be a lot easier of a process than trying to wing it.
That's good advice. And once again, Jason, I really do feel like we're going to have a few more of these conversations.
Well, I am in it to win it. So by all means, like I like talking about this stuff. It's fun. And if it's going to help, if anybody listens to this, that it helps even one person, it's worth it.
I agree. And also, I think it's important to know that by you even offering this much information will make people really, really understand the importance of the expert and the importance of doing your research,
100.
because that's not what's happening. Once again, I'm not saying everyone, I don't want to broad stroke people that much, but it is becoming a pattern where people just assume and that it's done. Like you bibbity bobbity boop things. Not to go all Disney, but yeah.
Agreed.
So thank you so much, Jason, for coming on.
It was my pleasure. Thanks for having me. And yeah, whenever I can jump on, feel free to set that up, and I'd love to do it again.
Oh, we're definitely doing this again.
Love it.
All right. I'll talk to everyone later.
All right.
Bye.
Be well.